Hello, everyone. I'm Ted Oakley, managing partner at Oxbow, and we have always a special guest in Jim Bianco. And Jim, we not only take his service, but we count him as a friend. And Jim, we're glad to have you today.
Ted, thanks. I look forward to the conversation.
I'm going to give you a couple of kudos to start out with because I'm one of those people that remembers May of 2020 when you said that the bond market, bull market was done. It was over. And a number of people thought, oh, I don't know about that. And yet that ended up being correct. And I'll give you another one. You've had some really great calls on this year, some months back, when everybody thought there'd be 6 cuts this year or more. You said, I don't think so. I don't think that's what we're going to get. So I always like to give credit to people because that's a tough business. And so you're on top of it right now.
Oh, thanks. I'm saving up the chits for the famine that comes when you get a couple of calls wrong.
I know the feeling.
Yeah.
Anyway, well, listen, your title, talking about is the 5% 10-year still in play. I know what's been going on lately. And I read your Financial Times op-ed last week. Very good, by the way. I'd recommend it to anybody. But take it from there. We'll see what you have to say here, Jim. Thanks.
Yeah. So let me start bigger picture. And the bigger picture is the economy seems to constantly be surprising to the upside. And I'm talking about constantly over the last 18 months or so, both in terms of growth and in terms of inflation now that it's seemed to swing up. Now, why is that? And I always like to remind everybody that whenever you have a financial crisis or a recession, and we had both in 2020, the economy changes. Change is not worse. Change is not dystopian. It gets different. And coming out of 2020, what we saw or what we've seen is higher levels of spending. And those higher levels of spending are coming in two forms. They're coming in fiscal form. The government's deficit to GDP is 6%. That is typically associated with a recession. That's how much the government is spending. If you want to put it in a different way, 22% of the US economy is currently the government, is GDP is coming from the government sector. And that is extraordinarily high. In only 2009 and 2020, the depths of those recessions was it higher than it is now. All the other recessions that came before it, we never got the government to 22%. And we're in year 4 of a recovery. And also, if you look at the consumer is spending too. And the statistic I'll give you is from 2010 to 2020, the savings rate in the US was 6%. So total personal income, all your W-2 and your investment income, and whether or not you got any government transfers like welfare or Social Security, less disposable spending, you were spending 94 cents of every dollar. You were holding back 6 to save 2010 to 2020. Since 22, it's been less than 3. So we're spending more money right now. Now, we could go into psychology of why we're doing it. Maybe it's PTSD of the lockdowns, revenge travel has become kind of a permanent thing. Or maybe it's a belief that now that we've broken the glass and we've sent people stimulus checks for thousands of dollars, I don't need to save because in the next downturn, they'll just mail me more money. Why? Because they mailed me a lot of money in the last downturn. So that's kind of the new trained habit. But the combination of personal spending and government spending has been pushing this economy stronger than people think. And that's why we don't have a recession, don't have a soft landing, and we have sticky inflation at around 3%. Now, how long will that last? Till the next recession. Because, something will come along and cause us to have another recession, whether that's later this year or in 10 years. And then things change again. And we'll see what type of recession we have and the composition of how it unfolded. And then we'll figure out how people change. So bringing it sooner or bringing it up to date in the last couple of weeks, we've seen some numbers like the payroll report was a little bit below expectations, a little bit of a higher jump in initial claims. The week before we recorded, the University of Michigan Consumer Sentiment Survey was a little bit weaker. I'm not too concerned that those are pretending some kind of slowdown because the economy had been running very hot for the last several months. So there might be a period where it runs a little bit cooler but nothing like a soft landing or recession. So with that backdrop, I've been arguing higher interest rates, and we've been getting higher interest rates. And when we got to about 470 to 475, I said from a tactical standpoint, look, we started to begin at the end of December, we were at 380 on yields. As late as early February, we were still under 4%. We jumped all the way to 470. I thought maybe we'd get the 10-year yield back to 5 to 5.5, 5 to 5.5. So at 470, from a tactical standpoint, I said, okay, most of the move is done. And there's an old saying on Wall Street, the pigs get fat and hogs get slaughtered. And so I'll take what I can get for most of that move and kind of tactically move to a neutral stance, thinking there still might be one more push up in interest rates to get us near 5%. What I suspect that will do is that will get us we'll get a capitulation. We'll get a lot of people talking about bearishness. Jamie Dimon wrote in his annual letter that we could see interest rates go as high as 8%. Yeah, that's where we're going to go. That kind of talk is what you'll get. And that will set us up, I think, for the end of this move and probably a multi-month rally in bonds. Not to change what you said before. I still think, 2020 was the low yield and we're in a multi-year bear market towards higher rates. Many, many years we're going to be dealing with higher rates, but this phase might be close to ending. And it's all about spending. We are spending, the government's spending, people are spending, and it's very hard to have a recession when they're spending, and it's very hard to bring inflation down when you get this level of spending.
Jim, let me ask you on the government spending, obviously it's a number that should be going on when we're having, a downturn in the economy, not like it is now. So what happens if you get a downturn in the economy? Do they have any room?
No, that's a good question. Usually the government likes to use that kind of Keynesian thought process that when the economy turns down, spend like crazy to try and stimulate it. But then the flip side of that's supposed to be when the economy starts to pick back up, which it has been doing for the last year and a half, is to rein in that spending because it's not necessary anymore. So the next downturn, do they have room to increase spending? Sure, they have room to increase spending, but if that spending brings about a consequence of higher inflation, then it won't do any good because they'll try and spend, but the result could be that dreaded S word, stagflation, weak real growth and higher inflation. And that would produce higher interest rates, and that would not make that kind of increased spending anything stimulative. So, yeah, I think they could be very, very limited unless the future downturn is so bad that it just puts aside the fears of inflation and that we just have to deal with a downturn. A quick word about downturn, real quick. There's an economist named Rudy Dornbush, and he used to work with the Fed and stuff, and he coined a famous line that Bernanke used to use all the time. A lot of economists use it, actually, and that is that economic expansions do not die of old age. They're murdered. And so people look at the economy and say, it's going to roll over, it's going to pop, and stuff. Economies don't do that. What typically causes a recession is a murder. What's a murder? A spike in oil prices, geopolitical crisis, suffocatingly high interest rates, and that's not 5%. A financial crisis, like a housing crash. Something comes along and breaks the economy. And I think that this economy will continue to expand until something breaks it. Now, if that break, whatever it happens to be, is so catastrophic, you could say, forget about inflation. It's taking care of that problem. Then, yeah, the government spending could really ratchet up without there being any inflationary impulse. But if that break is something more traditional, then that government spending could produce higher inflation and not be, responsive or stimulative at all.
And you would have how many meetings we have now? 2 or 3 before election?
Yeah, right now there's 3 more Fed meetings before the election. There's June 12th and the market's got like about an 8% chance that the Fed's going to raise rates at that. That's what's pricing. Then there's July 31st, which happens to be right between the Republican and Democrat conventions. Market's putting about a 1/3 chance the Fed's going to raise or cut rates, excuse me, at that meeting. September 18th is the next meeting after that. That's 7 weeks before the election. Market's about 50-50-ish or so. Fed might cut rates at that meeting. And then the next meeting after that is November 7th, which is 2 days after the election.
So I think if I've read you correctly, your thought process is that are they are not partisan, but they are political. I think that's the wording you used.
Yes.
That's reason why they would not probably make a move. You don't get something in June, then it's probably out.
Right. So partisan, not political. What that means is that no, they don't sit around the FOMC conference going, Trump said he's going to fire Powell if he becomes president, and Arthur Lafford is heading a group that's looking for the next Fed chairman. And Arthur Lafford looked around and said, I think Arthur Lafford should be the next Fed chairman. And so, that was like when Dick Cheney said that, he headed the vice presidential group and said, I think Dick Cheney should be the vice president.
Yeah.
And so I think that they're not partisan and that they're not sitting. I say all that so that I set up this. They're not sitting around the conference table saying, man, we don't want that. We don't want Powell to be fired. We don't want Art Lafford to be the chairman. So how do we sink the Trump campaign? They do not do that. But political, they know that July meeting in the Republican and Democrat convention, they know that September meeting is 7 weeks before the election. They don't want to be part of the narrative. They do not want to do anything that makes Trump and Biden talk about them. They want to be invisible. That's why I've often joked that to a rate cut was May, which they didn't do, June, which has only got an 8% chance, or bust meaning after the election, only if the data weakens enough to give them an opportunity to cut rates. But as I said before, it hasn't been weakening. So maybe it does. These are all forecasts, and forecasts can be wrong. Maybe it does, and they do cut rates. But I think that, if we don't get it in June, I'm looking after the election at the earliest if the data weakens.
But with what you're seeing, I think what you're saying is that we still have a chance at the 5 or more in the short run. Or do you think that? I guess that's a question.
That we stay at 5% interest rates?
5% on 10-year. We have a shot at it still.
Yes, I still think we have a shot at 5% 10 years, largely because short-term interest rates, the funds rate's going to stay at 5.25 to 5.5. The 2-year rate the week before we were recording, it did briefly go over 5%. And we could see, in market parlance, a flattening of the yield curve or an uninversion of the yield curve, that the 10-year yield, which is in a lower long-term rate than the 2-year yield, which is an inverted yield curve, might become a little bit less inverted, and we can make a run towards 5%. And that's why I've been focusing more on that 5 to 5.5, because I think if the answer is, could rates go above 5.5%, I think that would take a Fed hike in order to really do that. Talk about not wanting to be part of the election. Go ahead, Jay, and hike rates and watch yourself be part of the election. So even if the economy were to speed up, even if inflation were to continue to surprise, I think the bar, at least until November, to try and raise rates is extraordinarily high. Now, it's a very low probability there'll be a rate hike, but I don't think it's zero at this point.
And let me ask you this, on the economy, whether that would break down and the Fed would look at that and think, well, things are weaker. I'm assuming from hearing you that consumer spending would be the number one thing that's driving it. Obviously, housing is just stuck where it is, and productivity so. But I'm hearing you say that we're leaning on consumer spending to keep.
Yeah, consumer and government spending. I think the spending is what's driving this. The Fed is focused on the unemployment rate. And the unemployment rate for 27 straight months has been below 4%. You got to go back to 1970 to find another streak of 27 months of the unemployment rate below 4%. Now, if the May number is also below 4%, then you got to go back to 1953. It'll be 71-year record. So why is the unemployment rate so low? I think there's two issues there. I think one is what you pointed out, the spending. Look, if people are spending money, if the government is spending money, there's going to be jobs and there's going to be employment, and that's why the unemployment rate is so low. The other more nuanced answer I would give you about unemployment is that I do think, and we've talked about this in previous conferences, previous podcasts, excuse me, that the 2020 changed the whole mindset of work and ushered in remote work. Not work from home, that would be 5 days a week, but remote work, being partially in an office, partially at home. And it also has changed, especially for the non-professional side of the economy. Jobs are more transactional. People take a job, they'll do it for a while, they'll quit. They'll do something like take the summer off. And why would they do that? I mean, talking about non-professional jobs, because they know that in the fall they can come back and find another job. And I know from anecdotes that I've heard from people that, hire clerks and hire cashiers, that they kind of come and go more than they did. Now, in the professional class, let's define professional classes: somebody who got a college degree and somebody whose parents paid a lot for that college degree. No, you're not taking the summer off and going to the beach. You're going to get a professional job and you're going to go to the office every day if that's what needed to be. But that's not the majority of jobs in the United States. The majority of jobs in the United States would be, kind of below that level. And so the transactional nature of jobs is really showing up. You're seeing more part-time work. You're seeing, and part-time work for non-economic reasons. There is actually a category for that. So the job market is changing. And because of that churn, I think that's also structurally keeping the unemployment rate low as
But
well, too.
on that work from home, I mean, you came out, a number of years back and said, "Hey, the game's changed here. You need to wake up." Uh, but if you talk to a lot of commercial real estate people, it's almost as if, well, they'll be back. It's no problem. They'll be back. And I don't think you believe that. I think you believe that, no, that's a structural change.
Right. Now, remote work, like I said, remote work from home is 5 days a week. Remote work is a couple of days, let's say 2 days at home, 3 days in the office. There's always going to be a need for people to congregate in a central place called an office. It may not be 5 days a week, 8 hours a day. It may be 2.5 days a week, a half a day, 1 day, 2 days, or 3 days, or 4 days, or something like that. And that's to be determined by each individual circumstance. And so we have to kind of rethink what work is, and we have to rethink why we go there. And we have to then start to think about how much office space we need. And that is going to be a real issue, I think, moving forward as commercial real estate, especially office real estate, tries to figure out what this new environment is going to be. Now, there's an argument that people make too. Oh, don't worry, the next recession, they'll come begging back to the office. I beg to differ. People assign a monetary value to work from home. The next recession, your employer will say, I'm not going to give you a raise, but you can have another day at home. Oh, you just gave me a raise because you gave me another day at home. If you want people back in the office 5 days a week, pay them. Pay them more money to show up every day. But employers are not of that mindset right now. But so yes, we always have a need to go centrally located to collaborate, because we're doing this via Zoom, this podcast. And as I like to say, Zoom is better than not Zoom, but it is not in person. Nothing can replace in person. And so a lot of service sector jobs, a lot of remote type of jobs, your job comes down, my job comes down to two things, right? Things I have to do and people I have to collaborate with, whether it's coworkers, vendors, or customers. Collaboration is best done face to face. Things I have to do, sometimes that's best done at home. So no one walks in every 3 minutes and asks me, did I see the game yesterday? Or what are you doing this weekend? And I just get it done. And I get it done in a way that I could concentrate on it. So there is a value to remote work because we have a proficiency that we want to do in our jobs. So I don't think we're going back 5 days, and I don't think we're going to stay home 5 days, but I think it is a new environment. And what that means is that the office has to be kind of, to use the Disney term, reimagined. And maybe we're just starting to get there right now.
Well, you sure wouldn't have those expansive offices and expansive workspaces when you when you only got together 2 days a week. And that would certainly, that probably helps. I'm not sort of a question to you, but that probably helps consumer spending a bit too, because I'm not spending gas to drive an hour to get to the office. But on that same note, on consumers, what do you say about the people that say on the buy now, pay later and the plans that are out there, car payments at a super high level? What do you, what do you say to people about that? Is that really affecting the consumer, or eventually will, or do you think that's just part of the process?
I would put it as part of the process in that it will eventually um, affect the consumer. I think that in this mode, as long as the consumer continues to spend, that those buy now, pay laters and all those other schemes will continue to sort of kind of work. There'll be defaults and there'll be problems. It'll be the next downturn. If the consumer decides that they're done spending and if the consumer or can't pay those anymore. Now, keep in mind, there's two levels of spending going on here, right? One is there's more nominal spending because of inflation has cumulatively made things more expensive. But what I'm referring to is we're just buying more units. We're just buying more stuff. We're buying different types of services, but more of them because, the 3% on a savings rate versus the 6% savings rate is basically we're just buying more stuff. And that seems to be an attitude change that we're having. But yeah, all those things will keep us going. And how long will this last? Till that murder happens, thinking of what's the state of the Middle East and stuff like that. I like to tell everybody, look, would anybody be shocked if we wake up one day and there's screaming headlines all over the internet that there's an event that had happened and we say, uh-oh, here comes $200 crude oil? No, no one would be surprised. I hope to God it never happens, but that would be the type of murder that I was referring to on the economy. And if you got that type of event, then yeah, consumer spending and all that will change real fast. But until you get that event, I think the status quo will continue.
Well, I might switch to the stock and bond markets a bit, because you've talked a lot about the fact that if you could get 5 to 5.5%, that's about two-thirds of what the stock returns probably would be, or the stock returns may be less than that the next 10 years. But I guess my question to you would be, it seems as though that the euphoria is totally back in the stocks, in the housing. I mean, everybody feels rich right now because their houses are high, their stocks are high, and yet nobody seems to be worried about any of that. Does any of those things bother you, or how do you see
Yeah,
it?
oh yeah. Oh yeah. I mean, the day we're recording, meme stocks, the old 2021 meme stocks, GameStop doubled in the day that we're recording because we're back to doing that again. And we're starting to see, cryptocurrencies are starting to jump again. And we're starting to see the technology stocks started to really start to roar. Super microcomputer and NVIDIA just having spectacular years, and then horrific type of 40% corrections along the way in super microcomputer. So the animal spirits are here, and that kind of goes with the spending. If there's kind of an animal spirit type of mentality to the economy. So yeah, we're starting to see that kind of stuff. Now, to what you mentioned earlier, I think what's also happening, and I don't have any data to back this up, but it's just kind of an anecdote that I'm seeing. People are first of all, there is data to back up the first part that Dr. Jeremy Siegel put an update to his book, Stocks for the Long Run. In it last year, he said, what is the long-term prospects for the stock market? If you bought the S&P 500 index fund and you just held it for 10 years and then checked it 10 years later, like Warren Buffett tells everybody what they're supposed to do, you should expect 8% a year, 16% one year, 0 than 1 year, but average about an 8%. And that sounds about reasonable. Well, in 2019, when money market funds were 0 and bond funds were under 2%, we used to scream the word TINA. There is no alternative. You can't sit around in bond funds because you're not getting anything. Get into stocks. Okay. But in 2024, when a money market fund is 5.4% and a bond fund is yielding over 5%, which most of them are right now, people look around and use the money market fund as an example because that's the easy one to understand. Okay, I can get 2/3, maybe up to 70% of that long-term appreciation in the stock market with a $1 NAV every day. Now, it's not going to last forever, but as we talked about earlier, it could very well, it has lasted for a year, and it could continue to last until after the election. And maybe when if the Fed finds a reason to cut rates, then maybe I'll shift into a bond fund that's got a higher yield. I'll get most of the stock market's returns with less of the stock market's risk. The bond market in the first half of this year started off poorly. It was down 3%. If stocks started down 3%, no one would ever consider that to be poor. That's kind of the way that they go. So people are starting to look at bonds. Now, the antidote I would give you is I'm hearing more and more that people are saying, what is the new 60-40 portfolio? The old 60-40 portfolio used to be 60% in a broad basket of stocks, 40% in bonds. They seem to be arguing that the new portfolio might be 50% in bonds, 55% in bonds, and the other, but a bigger weighting in bonds. But that stock weighting, you got to get into ARK, and you got to get into the Magnificent Seven, and you've got to maybe have a little bit of hot sauce in crypto, so that when you buy into the stock market, you just don't want the broad-based stock market. Look at mid-cap stocks and small-cap stocks. They're struggling. You want to be in racier stuff, but you don't want to have, the majority of your money in that racier stuff. That's what the higher yield that bonds are offering you gives. So that's your base. And then you put that hot sauce, if you want to, that's the term that has been thrown out there, on top of it. Now, I look at that and go, man, that is kind of like the talk you get at a high. It's what that sounds like. I have to go for the super racy, get me into super microcomputer and NVIDIA and Mag 7. And why don't I have 3 to 5% in Bitcoin? And it's like, that is the kind of talk you get near a peak. And that seems to be the mentality. So yeah, the animal spirits are alive and well.
So Jim, I ran the numbers just last week. December 2021, and I took a 60-40 portfolio and I ran it through May the 1st, just a week or so ago. And the 90-day treasury beat it hands down for that period. Just 90-day treasury. Here's my question to you. In your op-ed at the Financial Times, I think you were implying, if I understood correctly, and you can correct me if I'm wrong, but I think I understood that you thought, well, there's a certain kind of stock bond portfolio that can come back some now, but you have to really watch where your coupons and where you put the duration. Did I hear that correctly or read it correctly?
Yes. So the op-ed, which was in Friday, May 9th, Financial Times, was written in response to Bill Gross wrote his monthly investment letter. Bill's retired, but he still writes his monthly investment letter. And he proclaimed total return, fixed income total return dead. Now, it's important to understand he invented it. He invented it in the 1970s. The idea that you want to mix a coupon plus price appreciation. And so it was significant that he said it was dead. And what I said in the op-ed was that a certain type of total return is dead, because what he had played for those decades at PIMCO very successfully was falling interest rates, and to be what we call in the bond market long duration, and to be just betting forever and ever and ever that interest rates were going to continue to fall. And and he made a lot of money, and he turned PIMCO into a multi-trillion-dollar asset manager, and it was huge. Now he said that that's dead, and I'll agree with him there, that if you're buying bonds because you think interest rates are going to go down and push the price up, that may not be the case. But now that we're in 2024 and we're stuck in a world, not stuck, but we have a world that offers you 5% coupons, 5% money market funds, and the like, total return means something different. It means that if you buy into a bond fund, you're going to get 5% coupon. Now, the bond fund manager's job is to hold that coupon. Don't lose that coupon. Now, if there's an opportunity to present itself by overweighting some sectors, underweighting other sectors, maybe even playing for lower interest rates or higher interest rates, maybe you can add a little total return on top of that and maybe push the overall return to closer to 6 or something like that. But don't turn it into zero over a longer period of time. That's what I'm saying is a certain type of total return is dead, but this type of total return still exists. Now, how do I know that that's the case? Look at the flows into bond funds. Look at the flows into money market funds. There's still money coming into these sectors. Why? Because people are looking at 5%, or if you're in a corporate bond fund, 6%. And they're saying, yes, sign me up for that. I'll take that. That gets me most of the way towards my goals of what I want to get. And that's where that whole idea of, well, what do I do with the rest of it? Hot sauce. You're not going to just buy the Russell 2000. You're going to buy, you're going to buy the Magnificent Seven stocks or an index of the Magnificent Seven
I would
stocks.
have to say we
So,
variation of that in that if you look at all three of our strategies, and we have about 45% that's in 1 year or less treasuries, and it's paid us for a long time now. It's actually paid us probably average 525, 530. And I think that's what you're talking about. You have to be careful that you don't go a long way out and get locked up, and then all of a sudden it's the wrong timing, because then you're right back in the mud again if that happens that way.
right. And one of the things I think you're starting to see too, in terms of, let me talk a little bit about the ETF space. Full disclosure, I do run an actively managed fixed income ETF as well. But what you're also starting to see in the ETF space is there's been a giant explosion of actively managed bond ETFs for this exact reason, is that there's a yield and I'd like to get that yield, but I don't want to jump on that 5% yield and then watch interest rates go up and watch and watch the returns flitter away. So people are turning to actively managed bond funds. Now, why are they returning to actively managed bond funds? Dirty little secret about the index investing world. We all know all the stories and everything, that like 80 or 90% of actively managed stock funds cannot beat the S&P 500. But the majority of actively managed bond funds can beat a broad-based index like the Bloomberg aggregate. Why? I'll give you a simple answer as to why. There's more nuances in there. But the simple answer is, in equities, your biggest weightings are your all-stars, your Magnificent Seven stocks. And if you're not fully in on all those stocks all the time, you can't beat the index. But in bonds, oftenly your biggest weightings are your problem children, your overlevered companies, your countries that borrow too much debt, your low in coupon mortgages. You can see that they're problems. You can underweight or avoid them, and then they become problems and you outperform the index. So that's why I think fixed income total return, in terms of, or active management to use it better, is seeing a resurgence, because we're starting to realize you just don't want to buy the index because most active managers can beat it anyway. And so you want to start to think about picking the active managers. Or the sports metaphor I've used is equity investing is like golf. You play the course, the S&P 500. Bond investing is tennis. You play the other opponent, which is another bond manager. And that's really who you're really competing against. The index itself is somewhere in the middle of the pack. And so there's lots of managers that can beat it, but then you want to pick the managers that are going to win Wimbledon, to stick with my my metaphor one step further.
Well, I've just for everybody's knows, we've included during this particular interview three or four times now the symbol for your exchange traded fund, and I think you're doing well with it. I certainly see the numbers are better than the averages, and that's been interesting. Let me ask you this: if you were to get a 5% 10-year treasury, we're call it 450 now, where do you think when it backed down and started going the other way, where do you think that would go to?
Well, now again, I still think there's one more push up, because I
Right.
just don't think
But I bet
there.
after that, I mean, if you got that,
Yeah,
then going the other way.
if I think that there is a long-term bear market in bonds, and the last low in December was 380, I think that the next pullback down in yields will probably not go below 380 unless we have a recession. And I don't think we are going to do that, unless that murder weapon shows up. So let's say 4.25 or somewhere around that line. Boy, that's if you do the math in bonds in a broad-based bond index, it's a 6 or 7% return. potential. If you get to 5% and then interest rates fall down to 4.25%, and then that sets the stage later on, unless of course that murder shows up and you have a recession, that you can have another push higher into 25 or into 26. But I think if you start thinking about the bond market in those terms and managing in those terms, then yeah, if 8% is what you could get in the stock market with volatility, and a 7 or 8% return for most people is a good investment return. What the bond market is doing is offering you a yield, or as my friend Jim Grant of Grant's Interest Rate Observer says, it's nice to have an interest rate to observe again. We have one now. And that does change the game. Now, it was extraordinarily painful from 2020 to 2022 to go from zero interest rates to 5% to get to this point. And that was a horrific period. And a lot of people are permanently scarred that hate the bond market, including maybe Bill Gross. But now that we're at 5%, it's a different game in the bond market.
Well, I know I ran some numbers today, just today, and if you had the 10-year at 5 and you went down to 3.5, it would be about an 8% return on the capital portion of it, on the principal. If you had the 5-year go down 1 point, it'd be about a 4% return. Here's my question to you. Is it worth it for the average investor to try to go beyond that 1 or 2 year look that we have right now to try to get that maybe one time 8%?
For the average investor, I'd say no. I'd say for the average investor, look at the gift you're getting at 540 on a money market fund and take that, and you get a $1 NAV every day. And remember, what should the stock market return you? Around 8%. Look, it might do better than that this year, but it did worse than that in 22. And when you kind of measure it all out, like I said, 65, 70% of it. Now, maybe there's a period in the future where the Fed really is going to cut interest rates and bring that return down on that money market fund, and you might want to look to short-term bonds. Maybe you want to look to an active managed strategy that will do that for you. That's another possibility. But if you're wondering, what can I do with my money straight up? That is a good place to start. Look, like I said, at the end of the day, if you can churn out a 7 or 8% return every year, you're doing very well. You're getting most of that right there in a money market fund. Thank you very much. Now you can figure out, you don't put 100% of your money in a money market fund. You put most of it in there. Now, what do I do with the rest of it in order to try and, get a little bit of a kicker on that? You don't have to go super microcomputer or Bitcoin or something like that, but you can go something else that you think might give you a little bit better, whether it's a broad-based stock fund or an active managed stock investor, or even a limited partnership if you think you've got some potentials in something like that along the way. But that's kind of the way that you got to start to think about this. The problem is, what's happening with a lot of people is that they're not thinking about, boy, if I could get 7% a year, I'm doing pretty good, and I could get 5.3 or something like that in a money market fund. Most people are thinking, I want 7% a month. And I want to know, what can I get into that's going to give me 7% a month? And the Bitcoin guys want 7% a day is what they want right now. And you're going to get 7% a day, both directions. That's the problem that you face when you start taking that kind of risk.
And Jim, if you go back over, 4, 5, 6 decades, the average person does not understand the number that you get from having a balanced portfolio. It wouldn't be 8%. And when you try to be realistic with them to say, this is what you should look for. And we always try to say, hey, well, you need to have a certain, a few points over inflation. That's where we're coming from here to keep buying power. But it seems as though today that Wall Street has sold them on this idea that, look, it doesn't matter when you go into it. It's all the same. And we think it does. We think timing is certainly important in here. And I know people today that probably don't realize this, but the S&P today, if you just go back to December 21, has not compounded very much relative. It's not that 7 or 8. So,
it's a couple of percent. It's like 2 or something like that since the end of 21 is what it's compounded at.
So what you say makes a lot of sense, that okay, if I could get part of my portfolio less than 12 or 18 months in the treasury and get, five plus, there's nothing wrong with that.
Right. And I think that it comes down to a mentality is that, let me say this bluntly, you should work to make your wealth, and then your wealth should help augment it by getting a 7% return. But too many of the Bitcoiners and the hot money crowd thinks that they need to gamble their way to riches. And I'm sure, and you know what, at the end of the day, it's like the lottery. Somebody always wins the lottery, right? But the vast majority of people that take that strategy, nearly everybody who doesn't win the lottery that takes that strategy, winds up losing at the end of the day. And so I think that that's really the way that you want to start to think about it. Like you said, what do I need my money to do? I need my money to, increase in value. It needs to beat the inflation rate. It needs to beat the inflation rate by a certain amount. And where does a balanced portfolio come in? Because the other thing you want to insulate yourself from, which even I do, Ted, I know you do, you want to insulate yourself from your own emotions. You don't want to say, I'm 35 years old and I'm going to hold this for 40 years and I want to be all in a Magnificent Seven stocks. Okay, you can say that. And then they correct 60%. And then you panic. You absolutely panic and you do something you really wish you didn't do. And that's where the balanced portfolio comes in. You'll get there, but you also won't wind up having to have a knot in your stomach along the way.
Well, I suppose we call that around here at Oxbow peace of mind money. You can sleep well at night and
Yeah,
know that everything's not going down together.
right.
I think that's what people have to think about with serious money is how are you protected? But Jim, as always, in your slides, of course, we'll see some of those. We've seen some of those during the interview, and you have the greatest base of slides of info of anybody. And so everybody will see your website and your Twitter handle, and they'll see the numbers there and see the what your exchange traded fund, the symbol of that. They can go see all of that. And I would highly recommend people to take a look at what you do. We've done it for years. And I don't know where you get that, how you put the database together, but it is excellent, I have to tell you.
Well, I'll say this real quick. I've always said to my kids, one of the best skills you can do is learn a language. It could be French, it could be Chinese, or in my case, it could be Python, or it could be R. And I've learned how to code, and it's really helped to put together that database of stuff.
It really has, because you've come up with some slides that are nobody else has. I mean, I have this stuff that's really great. But listen, as always, thank you very much for being here.
Thank you.
We hopefully we come back and get with you next year.
Thank you. Look forward to it next
All
year.
right.
Thank you.
Thanks a lot. Hello, everyone. I just want to say, if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe, and you'll see more of what we do here at Oxbow.